Hey everyone, welcome back to the channel. If you are preparing for your professional exams, or if you just want to finally understand how tax actually works when you buy a smartphone or order food online, you are in the exact right place. Today, we are starting a brand new journey into the world of goods and services tax, GST. Now let me clear a big doubt right at the start. If you look at your official exam syllabus, this foundational chapter might not be explicitly listed as a separate, heavy-weightage topic. But let me tell you a secret. You cannot crack advanced GST chapters like place of supply, value of supply, or input tax credit if your foundation isn't rock solid. Think of this as the master key to unlocking the entire GST law. So grab your notebooks, grab a pen, get rid of all distractions, and let's dive straight in. Before we talk about GST, we need to understand what a tax actually is. Broadly speaking, the government collects revenue via two main channels: direct taxes and indirect taxes. Let's break this down with two simple real-life stories. Story number 1. Let's talk about Mr. Ram. Mr. Ram works hard all year and earns a handsome income of 1 million rupees. At the end of the year, the government knocks on his door and says, "Hey Ram, give us your income tax." Mr. Ram directly pays 1 rupee, 50,000 out of his pocket straight to the government. Who is paying the tax to the government? Mr. Ram, whose pockets are feeling the pinch. Mr. Ram, when the tax burden and the tax payment fall on the exact same person, that is a direct tax. Examples: income tax and black money tax. Story number 2. Now Mr. Ram decides to celebrate his hard work and goes to an electronics store to buy a brand new laptop worth 100,000 rupees. But wait, the shopkeeper adds an 18% GST onto the bill, making it 1 rupee 18,000. Mr. Ram hands over 1 rupee 18,000 to the shopkeeper and walks away with his laptop. Now think closely. Does the shopkeeper keep that extra 18,000 rupees? Absolutely not. He acts as a middleman and deposits that 18,000 rupees into the government's account. Let's look at the twist here. Who paid the tax to the government? The shopkeeper. Who actually bore the ultimate burden of that tax? Mr. Ram, the consumer. This, my friends, is an indirect tax. The burden is shifted seamlessly from the business owner to the final customer. And GST, along with customs duty, falls right into this bucket. Now you might ask, "Sir, can the government just wake up one morning and start collecting random taxes from us?" The answer is a massive no. Our Constitution is the ultimate boss here. Look at Article 265 of the Constitution of India. It strictly states, "No taxes can be levied or collected without the authority of law." This means the government must pass a proper act in parliament or state assemblies before taking a single rupee from you. To keep things fair between the central government in Delhi and the various state governments, Article 246 gives us the 7th schedule, which divides the power to make laws into 3 distinct lists. 1. Union list. List Y. Only the central government can make laws here. Think of massive national sectors like the railways, national defense, and customs duty. 2. State list. List 2. Only state governments hold the remote control here. Think local matters like the state police, public education, betting and gambling, and agriculture. 3. Concurrent list. List 3, where both center and state sit together to make laws. But here was the big problem in the old days. Before July 1, 2017, the tax system in India was a chaotic puzzle. If you manufactured goods, the central government levied excise duty. If you sold those goods within a state, the state government levied VAT, value-added tax. If you provided a service, the center levied service tax. It was messy, complicated, and full of double taxation. The government wanted a unified India, one nation, one tax. But how do you give both the center and states the power to tax the exact same transaction without causing a massive constitutional fight? They brought in the 101st Constitutional Amendment Act and inserted a brand new, revolutionary article, Article 246A. This article gives concurrent, simultaneous power to both the central and state governments to levy GST. Because of this, we now have the dual GST concept. Let's look at 2 critical examples that you will see throughout your career. Scenario 1. Intra-state supply within the same state. Let's say Mr. Ram in Rajasthan sells goods to Mr. Raju, who is also in Rajasthan. Because both parties are in the exact same state, this is called an intra-state supply. If the sale value is 100,000 rupees and the GST rate is 18%, a total of 18,000 rupees tax is charged. But watch how it is split under the dual GST model. CGST, central GST, at 9%. 900,000 rupees right-pointing arrow goes straight to the central government. SGST, state GST at 9%. 900,000 rupees right-pointing arrow goes straight to the Rajasthan state government. Single transaction, 2 equal slices of tax collected simultaneously. Scenario 2. Interstate supply, between 2 different states. Now imagine Mr. Ram in Rajasthan sells those same goods to Mr. Raju, but Mr. Raju is sitting in Punjab. Since it crosses state borders, it is an interstate supply. Here, we don't apply CGST or SGST separately. Instead, we apply a single unified tax called IGST, integrated GST, at the full 18%, which comes out to 1,800,000 rupees. As per Article 269A, this entire 1,800,000 rupees is collected upfront by the central government. But the center doesn't keep it all. It splits it 50 to 50. 900,000 rupees stays with the center, and the other 900,000 rupees goes to the state. But which state gets it? Rajasthan or Punjab? Remember this golden rule forever. GST is a destination-based, consumption-based tax. The tax revenue always goes to the state where the goods are ultimately consumed. Because Mr. Raju is consuming the goods in Punjab, Punjab gets the state's share of the revenue. Intrastate supply is taxed by CGST and SGST. Interstate supply is taxed by IGST, which is then split between the center and the consuming state. To make this massive system legal across the length and breadth of India, the government had to pass a network of laws. When someone says GST law, they aren't talking about just one single booklet. They are talking about a total of 35 different acts running in parallel. Let's count them together. 1 CGST Act governs the central portion nationwide. 31 SGST Acts. This includes 28 states, plus 3 union territories that have their very own legislative assemblies, namely Delhi, Puducherry, and Jammu and Kashmir. 1 UTGST Act, for the union territories without their own local legislative assemblies. 1 IGST Act, to govern all interstate movements. 1 GST, Compensation to States, Act, to help protect states that lost revenue when switching over to the GST model. Add those up. 1 plus 31, plus 1 plus 1 plus 1 equals 35 acts. On top of these 35 legislative acts, as a student or practitioner, you also have to keep up with the notifications and circulars issued by the CBIC, Central Board of Indirect Taxes and Customs, the Annual Finance Act, and landmark judicial decisions from courts. Now let's tackle the biggest conceptual question. Why did we actually need GST? What was so wrong with the old system? The absolute #1 enemy of the old tax regime was the cascading effect of tax, which simply means charging tax on top of tax. Let's look at the mathematical proof on screen to see how GST completely rescued the Indian economy and lowered prices for consumers. Phase 1, at the manufacturer level. Imagine a manufacturer creates an item. The cost of production is 1,000 rupees, and they add a profit margin of 500 rupees, setting the basic price at 1,500 rupees. In the pre-GST era, the center levied a 10% excise duty on the basic price, which added 150 rupees, making the subtotal 1,650 rupees. Then, when the state applied its 10% VAT, it didn't calculate it on the basic 1,500 rupees price. It calculated it on the full 1,650 rupees. That meant you paid 165 rupees in VAT. Do you see what happened? You paid tax on top of the 150 rupees excise duty. The final price came out to 1,815 rupees. In the post-GST era, we calculate a clean 20% GST directly on the basic price of 1,500 rupees, which equals 300 rupees. The final price is 1,800 rupees. Right off the bat, you save 15 rupees due to the elimination of tax on tax. Phase 2, at the distributor level, the real magic. Now, the manufacturer sells the item to a distributor. This is where the old system truly broke down, due to a blockage of credit chains. Under the old system, a distributor could not use the excise duty paid earlier to offset their VAT liability. The credit chain was broken. Look at the numbers. Pre-GST, the distributor's starting cost was the full 1,815 rupees because they couldn't claim a credit for the input excise duty. They add 200 rupees cost and 500 rupees profit, pushing the new basic price to 2,515 rupees. They can deduct their local VAT credit of 165 rupees, leaving a net price of 2,350 rupees. They then apply a 20% VAT on that amount, adding 470 rupees, bringing the final retail price to 2,820 rupees. Post-GST, the distributor's true cost is only 1,800 rupees. They add 200 rupees cost and 500 rupees profit, making the basic price 2,500 rupees. They get a full input tax credit for the entire 300 rupees GST paid at the previous stage, bringing their credit-adjusted cost down to 2,200 rupees. They apply the 20% GST, which equals 440 rupees. The final price to the consumer? Just 2,640 rupees. Look at the massive difference. By seamlessly clearing the credit chain and eliminating multiple layers of taxes, the consumer saves a whopping 180 rupees on the exact same product. When GST rolled out, it absorbed a long list of old taxes. Central taxes like excise duty, countervailing duty, CVD, service tax, and central sales tax, CST, were all packed up and placed inside GST. State taxes like local VAT, entertainment tax, octroi, entry tax, and luxury taxes were similarly subsumed. But look out, there are some very important exceptions that you must remember for your exams. 1. Permanently excluded, non-taxable supply. Alcoholic liquor for human consumption is completely out of the GST net. In fact, for upcoming exams, remember that this exclusion also strictly covers undenatured extra-neutral alcohol, ENA, or rectified spirit, used directly to manufacture alcoholic beverages. States fought hard to keep this revenue entirely to themselves, so it is still taxed under the old system of state excise and VAT. 2. Temporarily excluded. There are 5 petroleum products: petroleum crude, diesel, petrol, natural gas, and aviation turbine fuel, ATF, that are temporarily outside GST. Currently, they still attract old-school excise duty and VAT. They will only be brought under GST from a future date recommended explicitly by the GST Council. 3. The dual overlap category, tobacco and narcotic drugs, are unique. They are fully covered under GST, but the government also retains the right to levy traditional excise duties on them. So if you buy tobacco products, you end up paying both GST and excise duty. Since GST is a joint tax managed by both the center and the states, how do they make decisions without constantly arguing? To solve this, Article 279A authorized the President of India to form a powerful decision-making body called the GST Council. Who sits on this council? The chairperson, the Union Finance Minister. Members, the Union State Minister of Finance, alongside the finance ministers, or any other nominated ministers, representing every single state in India. The GST Council acts as the ultimate steering committee. They vote on and recommend tax rates, decide which items should be exempted, determine registration threshold limits, and plan exactly when those 5 petroleum products should officially enter the GST regime. They also designate special category states that require extra economic support and separate rules due to their unique geographical layouts. There are 11 special category states you need to memorize. The 7 Sisters of the Northeast: Arunachal Pradesh, Assam, Mizoram, Manipur, Meghalaya, Nagaland, and Tripura, plus Sikkim, Jammu and Kashmir, Himachal Pradesh, and Uttarakhand. And that, ladies and gentlemen, is the complete foundational blueprint of the goods and services tax in India. Now, when we step into the next chapter and talk about advanced concepts, you'll instantly understand exactly why the rules are written the way they are. If this step-by-step breakdown helped clear your concepts, please hit that like button right now, subscribe to the channel, and share this video with your fellow study groups. Drop a comment below if you have any doubts, and I will personally reply to them. Keep studying hard, keep your concepts clear, and I will see you all in the very next lecture. Bye-bye!